About the stages of investing and how this affects risk, return, and liquidity. Each type of investment comes with a certain amount of risk, and we'll tell you about that too. The first step is a put and take account, and that's like a savings account or a checking account, and that's for when you're just starting to get money and you don't really want to risk it because you still need money to pay the bills. So you don't get a lot of returns off this, but it is very safe and you can take your money out whenever you want, which is high liquidity. The next step is beginning to invest, and this is moderately high liquidity, but it is less liquid than a put and take account because you are putting your money in the stock market. So you would buy stock on things that are low risk, like a company that consistently does well would be a good idea. You don't get as much returns, but it is relatively safe. Step 3 is systematic investing, and this is lower liquidity because you're investing on a regular and planned basis. The stage has long-range goals, so the more you spend on it, the better your return on money will be. The liquidity isn't as high because it's more difficult to get your money to get to your money once it's in the stock market, and the risk increases because the stocks you buy could do poorly. Step 4 is strategic investing, and this is managing your portfolio and paying special attention to balancing out losses and gains. This stage has goals of 5 to 10 years. It's not high in liquidity and it's pretty risky, but there's also a high return rate, and it's really important that you don't want to put all your eggs in one basket. You want to spread out your money, so even if a company does poorly, you still won't lose it all. The last step is speculative investing. It's very low liquidity, and it has the highest risk, but it also has the highest return. Some people never get to this step, and it includes investing in penny stocks or collectibles like art. Low-risk investments include saving accounts and checking accounts. Your money is considered safe and easily accessible. Certificates of deposit are low risk too, but they are low in liquidity because there's a time limit. Bonds and utility stocks are considered low risk, but they're a step up because your money is going to the government and in the stock market. Moderate risk investments include mutual funds and stocks. They're moderate risk because they can make you money, but there's a higher chance in the previous investing methods that your money could be lost. The stock market is a gamble that you have to be willing to take to make more money. High-risk investments are gold, artwork, and collectibles. These are high risk because there might not always be a buyer for this market, and you have to be pretty knowledgeable about the topic to know when to buy and sell.